I'm delighted to introduce our guest for today, newly appointed fixed income portfolio manager Brian Carney. Joins Mawer with over 30 years of investment industry experience on both the sell side and the buy side. And his focus here at Mawer will be researching and investing in credit securities from across the globe. Great to have you here today, Brian.
Great to be with you, Kevin.
Now, we don't normally start the podcast with biographical details of our guests. Given you're newer to the firm and it's your first time on The Art of Boring, it'd be great to hear a little bit about how you got started in the business, some of your experiences, as well as what drew you to the credit markets.
Okay, Kevin, better sit down for this one. Good thing you are sitting down. I may surprise you, I wasn't born a credit analyst. I don't think anyone is. People are born equity analysts, and then they have to get converted. So going way back, look, my dad taught teachers to be teachers at University of Alberta. My mom was an elementary school teacher until she stopped to raise 4 kids. So my sister, the oldest, went to U of A. She dutifully went into the family business, and she taught English at Vancouver Island University. I've got 2 older brothers. They ended up leaving Edmonton. They went to go to school in Boston, and then they went into finance, and ostensibly because they had student loans to pay off, and Wall Street investment banks tended to recruit at Ivy League schools. So I followed my 2 older brothers down to the U.S., first for school, and then I joined the credit department at Goldman Sachs. And interesting to us, we all ended up working for the same gentleman, Dick Davis, who had joined Goldman from Moody's Investor Service. So how did I get into financial services? I fell into it. All that to say, Goldman was an amazing learning ground. I was 23. I was a political science major. I knew nothing about finance, about credit, nothing about the stock market. Shortly after I joined, in fact, only a few weeks after I joined, a firm named Drexel Burnham went bankrupt, and that was Michael Bilkins, the junk bond king. That was his firm. Robert Maxwell looted the Mawer Group pension plan about a year later. And then I was lucky enough to head over to the UK just in time for George Soros to take down the British pound. So for me, finance was fascinating. It had real world implication. And Goldman seemed to be in the middle of it all. So as much as I fell into finance, I also fell into credit. And what's attractive about credit? I mean, credit touches everything. It's what feeds or starves the global economy. And more specifically, when we think about the credit markets, they're large, and thankfully they're equally as inefficient as the equity market. So there's lots to play in. Creditors are lenders, and lending involves not just fundamental analysis, but also contractual analysis. And for some of us, that kind of complexity is very interesting. At least it's interesting to me. The universe of companies we get to look at is larger than the equity market, because our universe includes both public and private companies. And once you decide you might like a company, your job's really only half done, because you need to decide what term do I want to lend for and what part of the capital structure do I want to be in. So I find that very compelling. And it's interesting, all sorts of scenarios where you can have a positive outcome. And somewhat perversely, in the same name, you can have winners and losers. So you really need to do your homework. And you can make money in distressed and bankrupt companies, which is very difficult to do in the equity market. So there's always something new. No 2 days are the same. And so going back when I walked through the door at Goldman 30 odd years ago, I never thought I'd make a career in financial services. I guess that's the advantage of being the youngest of 4 kids. But I'd say in an instant gratification world, fixed income seems outrageously pedestrian, and credit is ludicrously old school, and that's why I love it. Credit really puts to bring it back to more, puts the boring into be boring, make money.
Awesome. That's so it sounds like you've covered pretty broad spectrum of the credit markets, be it geographically where you've worked. You mentioned you moved to the UK, you've worked in the US. And you also were kind of there in the earlier days of the high yield market, it sounds like. So really very useful experience, of course, for running a credit fund. I guess if we were to look at, so that's kind of how you ended up in credit. What brought you to Mawer? Why did you join Mawer?
I'll give you another multi-part answer, Kevin. You'll get used to these. I'm a list person. I really felt there was a unique opportunity at Mawer to build a global credit business within an exceptional, distinctly Canadian firm that had a sterling reputation. And as someone who, it may be obvious, is in the second stage of his professional life, there was simply no way I could pass it up. So specifically, when I think about Mawer, there's already an existing fixed income platform here, and I think it's one of Mawer's best kept secrets. The firm already manages about 10 billion Canadian in fixed income assets. So I'm coming into a phenomenal firm with a well-established fixed income business. I get to work alongside Krista Coughlin and the rest of the fixed income team. So that's point number one. Point number two, there's a global coverage advantage here. And I think the world may view Mawer as an equity specialist, kind of a group of excellent, understated stock pickers, but really I view them as a bunch of securities analysts. So we've got over 40 people here executing bottom-up fundamental research across the capital structure of companies around the globe. So in my opinion, there's no other Canadian credit-focused firm that has the global connectivity and coverage that Mawer does. So I think that's incredibly compelling. And the credit team plugs in directly to the broader team and their knowledge. The third point I'd make for me, and this is more personal, it really feels like a homecoming of sorts. And I remember growing up in Edmonton, sitting in the kitchen, my mom had the radio on, and Peter Lougheed way back in the 70s was talking about the need for Alberta to diversify away from oil and gas. I had no idea what that meant. I mean, I was in kindergarten. Who knows what diversification means? And I know those diversification arguments are still going on in Alberta today. So I don't know exactly what inspired Charles Ward to start this company, but 50 years later, it really is one of Alberta's global non-energy champions. So it's a true diversification success story. And so as a native Albertan, it's a homecoming of sorts for me, even though I'm based here in Toronto. And I think the last point, which of all the ones is probably the most important, it is the most important. The culture at Mawer, firm culture focuses on clients, community, and employees, on, quote, making people's lives better. So joining with a group of people pursuing excellence and doing it in the right way, not because it's their job, but because it's their passion, is very special. So I'm thrilled to be a part.
If I could pick up on the your first point around the fixed income platform at Mawer being one of the best kept secrets, when we think about the evolution of fixed income at Mawer, of course, you've joined us and a few other members of the team have recently joined to launch a new strategy, the Mawer Global Credit Opportunities strategy. Can you just sort of paint me a picture a little bit as to what that strategy is, what it's attempting to accomplish, and what problem is it trying to solve for investors?
The new strategy attempts to solve investors' fixed income challenge. So people don't expect to lose money in fixed income. And after decades of falling yields, market moves over the last couple of years, up until very recently, actually, really violated that premise. So people who always believed they needed fixed income have been asking, why should I have any fixed income? So in my view, losses in fixed income shouldn't lead to, I don't want any fixed income. It should lead to an examination of what type of fixed income am I holding? And am I holding fixed income that is both going to preserve capital in difficult markets and take advantage of opportunities that are presented at various points in time? So we are trying to provide an alternative strategy to passive, or I'll call it near passive fixed income, which strategies protect them from neither adverse credit or interest rate moves. So, and they certainly don't take advantage of the periodic market upsets that provide capital appreciation opportunities. So we're managing a new strategy with an absolute return focus. That means preserving capital in expensive markets, migrating to higher credit quality, shorter duration if that's what's appropriate. And when markets are cheap or distressed or dislocating, we're meant to take advantage of that opportunity, and we're meant to move rapidly and decisively so we can create significant capital appreciation potential. So we're trying to give people an alternative to either exiting fixed income entirely, or perhaps for retail investors going into GICs or institutional investors thinking about annuitizing portfolios. There are alternative strategies where you can extract significant value out of the fixed income markets. We think the global credit strategy is one of those.
Gotcha. So corporate focused, unconstrained in that you're flexible on credit, you're flexible on duration, ultimately seeking best opportunities wherever that may be.
Nailed it.
That's a very broad opportunity set that you've kind of painted a picture of. How do you think about sort of narrowing down that opportunity set to find the best ideas? And what types of opportunities are you looking for? What types of dislocations in the credit market would you be focused on?
Yes. So point one, investable universe is huge. And as we look at it and define it, it's well in excess of 20 trillion Canadian dollars. So about 2/3 of that is denominated in US dollars, 20% in euros, and then you get into the peripheral markets, sterling, yen, and our favorite Canadian dollars. And the companies within that universe, about 50% are domiciled in the US, about 20% in Europe, and then trickles on down. So there's a whole lot of stuff that we could potentially look at. We have put together what we consider a fairly sophisticated screening tool. Kevin, you can come take a look at it and tell us if it's sophisticated or not based on what you've seen. But it really helps isolate down to what is a much more manageable universe of names to kind of dig into. And then from that, get down to the 30, 40, possibly 50 names that ultimately go into the portfolio. So it's a similar exercise using a different screening tool that our colleagues on the equity side utilize. Kevin, I think it's important to outline what the strategy is not as much as what the strategy is. So the strategy is not dedicated to high yield. It's not dedicated to leverage loans, not dedicated to private credit. It's not dedicated to emerging markets. The latitude exists within the strategy to invest all of those various sub-asset classes, but it's not our focus. If something's really compelling in high yield, we'll invest in high yield. But we don't have to have any high yield in the fund. If the markets are expensive, we'll migrate up to much higher quality. So what type of dislocations are we looking for? Could really put them into two different baskets. One is issuer specific. Something happens to a company, the market perceives it negatively, credit spreads widen, bond prices fall. We look at the situation and our analysis says the company will survive and the prices of the securities provide enough protection for us to get involved. So if you think over history, any number of big company names have run into trouble. You think Boeing a few years ago with the 737 MAX, Boeing, unfortunately, having more issues today. So those types of names where there's a company-specific event, we dig in, we take a different view than the markets, and we can take advantage of that for our investors. And then there are the overall market dislocations, which aren't as frequent as the company-specific events, but they do come along. It's very hard to predict when they're coming or what precipitates them. But think of credit crisis in 2008. Think of Euro debt crisis 2001. Think of pandemic 2020, where there's an external event and all of a sudden everything becomes cheap virtually overnight. And so for that, like our colleagues on the equity side, we have a backup inventory list of names we think are interesting, possibly compelling. At the moment, the prices aren't right. But when you have one of these market dislocations, all of a sudden things become very interesting all of a sudden. So in those types of environments, the complexion of the portfolio from a credit quality point of view can change dramatically in a very short period of time, going from very little high yield to a much higher percentage of high yield. Unlikely to ever go to 100% high yield, because if the high yield markets are selling off, there's a good chance that the investment grade markets are selling off too. So you probably have a mix of unique situations in both high yield and investment grade. I would say one of the things that's very important in this strategy is if things are expensive, you need to protect capital. And the more capital you protected at the top of the cycle, the more capital you have to put to work at the bottom of the cycle, and the greater the capital appreciation potential that you can create in this fund. So preserve capital in expensive markets, take advantage of opportunities when they come along.
Excellent. And so I guess in the current environment, where would we fall on that range of preserving capital versus thinking more opportunistically?
Yeah, I mean, this is my first podcast. I'd love to say, hey, we're going to be at 80% high yield because there's a whole bunch of cheap stuff out there. Unfortunately, that's not the case. If you think about credit spreads, incremental spread compensation that you got or that you get today for lending to a high quality U.S. company, they're at reasonably tight levels. So historically, you earned about 1.5% above U.S. Treasuries to lend to high quality U.S. companies. Today, it's about 1%. For lower quality companies, Mike Milken's old junk bonds, high yield bonds, today you get about 3.75% for lending to that type of company. The long-term average is about 5.4. So high yield and investment grade spreads are reasonably tight. The good news is, I'll give you some good news, Kevin, is benchmark yields are higher than they were a few years ago. So if you think a U.S. 10-year is about 4% today, 3 years ago, that was 1%. So spreads are tighter, benchmark yields are higher. So there's actually some income and fixed income these days, which is good. But overall, spreads are a bit skinny, and we expect corporate defaults to rise over the next 12 months or so. So in this environment, the emphasis is more on protecting capital, and we think that's much better than diving kind of whole hog into high yield. That said, when we think about the portfolio, we've been able to put together a group of companies with a yield in excess 5.5%. And so to put that in context, the yield on a 5-year Government of Canada bond is about 3.5%. So we think that's pretty decent for where we are in the cycle. Again, more focused on preserving capital, waiting for the next opportunity.
And then within that that portfolio that you just mentioned, maybe if there's an example or two of, you mentioned there's always opportunities in the market. It's, you're sort of talking high level spreads, maybe being a little less attractive, but sort of looking under the hood, that bottom up work that you guys do, there's always opportunities. So where right now do you see some opportunities?
So I can kind of give you three different buckets. And these have been sourced by our internally developed screening tool. We're also building on the in-house analysis that's already been done by our friends on the equity side and just through kind of years of experience. So one of the areas where we think it's a good place to be at the moment, Maple bonds. And for those who aren't familiar, Maple bonds are non-Canadian companies who've issued in Canadian dollars. And there's a variety of reasons that companies do that. We don't need to get into that. So we think there are some shorter dated Maple bonds that are a good safe haven and provide a pickup versus domestic competitors. So Heathrow, the airport over in the UK, has borrowed money in Canada. It's a decent low single A type credit. You can pick up 125 basis points buying a Heathrow bond. JP Morgan has a short dated bond. You can pick up a little over 100 basis points owning that. And JP Morgan, even though it's a much bigger bank, we think probably more stable than many of the Canadians, trades a little behind Canadian banks. And then Verizon also has short dated paper, and Verizon, very strong investment grade telecom company down in the US, again, trades a little behind where domestic Canadian telecom companies trade. So we think that's interesting. And I'd point out, Kevin, that JP Morgan and Verizon are both well known on the equity side here at Mawer, and their holdings in some of our equity strategies. So again, we talk about leveraging the large installed knowledge base here on the equity side to the advantage of our fixed income investors. I think JP Morgan and Verizon are good examples of that. A name on the industrial side, Brunswick Corp. I don't know if you have a cottage, Kevin, but if you've been in a recreational boat anytime during your life, you were probably powered around by a Mercury motor. And Brunswick Corp is the company that makes those. Solid cash flow generating company. We've got a 7-year bond that yields about 1.75% over comparable U.S. Treasuries. Very good investment grade company. So that's an example of an industrial name. Even in a relatively expensive market, you're getting significant pickup for lending money to Brunswick. And then on the high yield side, another pick of our equity friends, this one, a Canadian name, Matter, if I'm pronouncing that right. They've got a Canadian high yield bond outstanding, and the Canadian high yield market is really small. But Shawcor, Matter, has issued in the Canadian market. They've got a 2026 bond, which if it gets called on its first call date, yields about 6.3%. So again, another interesting, stable company, well known to our colleagues on the equity side. So you've got Maple Bonds, you've got an industrial example, US pay issuer, and then you've got a high yield example. So those are the types of names that are in the portfolio, and those are the types of names in this environment that we'd consider going forward.
Excellent. Okay, so always sounds like there's opportunities. It's just a question of course, where and scaling your position. So basically thinking about your risk budget as well.
Nailed it.
If we were to shift, if we were to shift gears a little bit and think about sort of asset mix or asset allocation. So you've made some compelling arguments as to why this type of strategy makes sense, especially in light of what we've seen over the last number of years in more traditional fixed income markets, headwinds with rising rates, uncertainty now with interest rate volatility. But if investors were to think about where do they source or where could they potentially source room in their portfolios for this type of strategy? So in other words, if they were trying to create a well-diversified portfolio, how does this fit? Where does it fit in?
A couple ways to answer that question. First is reaffirming the need to have fixed income in the portfolio. So if you think about why do institutions have fixed income, diversification, income, and both capital preservation and capital appreciation potential. So I think individuals, institutions reaffirm we need some fixed income. I like to say fixed income is as critical to a sound investment plan as rain is to farming. You don't want too much, but if you have too little, it can be devastating. So reaffirm fixed income. And then how does credit fit? I think this strategy first is suitable for both individual and institutional investors with a long-term investment horizon. If you're about to make a down payment on a house in 3 months, this is not the strategy for you. You have to have a long-term investment horizon. Second, it could be the entirety of your fixed income holding. I believe that. And managing with a capital preservation opportunistic bent, it could be the entirety of one's fixed income holding, or it could be a specialty sleeve within a much broader fixed income allocation. So I think it's a good fit for people with set spending requirements. Again, individuals, endowments, foundations. It's got an attractive return profile. So you could pair it with other fixed income. You could actually, depending on your view or your institution's view on where we are in the equity markets, you could actually think about this as an offset or a reduction to some of your equity exposure. So I think there's a number of ways that this strategy fits. What I would say to people watching, we think it's very important that people understand our process and how we've come to pick the holdings that are part of the strategy. So we aim for transparency, and the more an investor knows about the how and the why decisions are made, the better, and the better they sleep at night, and they can leave the sleepless nights to us. So I think this strategy fits in a whole bunch of different ways. We very much look forward to talking about the strategy, where it may fit with all the people out there, individuals and institutions.
Yeah, I definitely concur on it's important to understand the process and the philosophy. Perhaps we can have you on the podcast a second time to go through that, because that'll be a whole other...
What date works for you?
Absolutely. Like that'll be a whole other set of interesting topics that we should go through as well at another time. Maybe just a final question to wrap things up. So we've talked a lot about your background, why we've launched the global credit strategy, some of the compelling reasons that investors should consider. I guess the obvious last question would be, why should investors consider investing in our strategy in particular? Why do global credit with Mawer?
Well, I think there's a number of reasons. And I think ultimately it comes down to, I believe we've got the best chance to pick the cheapest securities when those opportunities become available. We've got 40 plus investment professionals who do nothing but look at individual companies around the globe and try and figure out what makes those companies tick. So we've got the best research team, I'm convinced, in the country, possibly the world. We've got what I would call a large installed knowledge base. We have a proprietary system internally that we call M42, where all of that analytical information is stored and warehoused and is accessible to anyone on the research team, myself and the fixed income team included. So we've got access to an enormous amount of information. The screening process, which I mentioned, helps us kind of take that big investable universe of over 30,000 bonds and bring it down into something manageable, which we can then marry up with M42 and our existing analytical expertise. And then I think the final point is the unconstrained nature of the strategy. So we're not tied or forced to invest in high yield or forced to invest in leveraged loans like many strategies are. We have the ability to move anywhere on the credit spectrum, anywhere on the duration spectrum. And when you're focused on preserving capital, taking advantage of opportunities, focused on making sure you generate positive absolute returns over the life of the strategy, I think that's the way to go. So I've given you 4 reasons. When we do the next podcast, I promise I'll give you 4 more, but I think those are 4 pretty good ones.
Excellent. I appreciate the lists. I think in lists as well. So that's a helpful way to frame it. So it's been awesome chatting with you today, Brian. Hopefully the first of many conversations together. We've already got another one earmarked. So hopefully we'll do that sometime soon. And thanks so much for your time today. It's been great.
Thanks for having me, Kevin. Appreciate it.